Welcome to the Deep Dive, the only show that takes that huge stack of research material you wish you had time to read and, well, distills it into immediate structured knowledge. We don't just skim the headlines, we give you the foundations.
Today, we are deep diving into inflation. And it is the single most important concept in macroeconomics. It's the force that governs everything from your retirement savings and the price of oil to geopolitical stability and national elections.
Absolutely.
It is the universal signal for the health of any modern economy.
It really is. Inflation dominates the news, yet the underlying mechanisms, the history, the conflicts over how we measure it, the intellectual battles over what causes it, all of that is often lost in the noise. Our listeners ask for a thorough, a rapid understanding that moves way beyond simple definitions.
And that's our mission today. We have to establish the core concept right away. Inflation is defined as a sustained increase in the average price of goods and services over time.
Okay, the average price is a key distinction.
It's the critical takeaway. This doesn't mean everything costs more. It means the currency itself has lost purchasing power. Each dollar or pound or euro just buys less than it did yesterday.
Okay, so let's unpack this and set the stage for our journey. We've analyzed a really comprehensive body of source material spanning centuries of economic thought.
A lot to get through.
A lot. We'll tackle three major areas. First, the surprising ancient roots of this, of currency devaluation and why the terminology itself has shifted. Second, the contentious debate about how we measure this force and, what competing theories claim causes it.
And that's where the real intellectual fights are.
Exactly.
Right.
And third, the double-edged sword, the dramatic negative effects contrasted with the surprising upsides that make central banks actively target moderate price increases.
Our goal is to move you past simply knowing that prices are rising. We want to give you the intellectual tools to understand the crucial why and the how. This means grasping the foundational theories, from classical quantity theory all the way up to the modern synthesis, and understanding where economists genuinely disagree about the levers of control.
Let's start by tightening up the language, because even economists, and definitely politicians, misuse the term inflation all the time.
That's essential. We have to be clear that inflation is the general trend of prices, which signals a change in the value of the currency itself.
Okay.
It is not, for example, when the price of gasoline goes up because a refinery shuts down.
Or avocados get more expensive because of a drought in one region.
Exactly. Those are specific price shifts. They're driven by very localized supply and demand imbalances. They might nudge the overall average, sure, but they are not the general systemic devaluation of the dollar.
So the inflation we're talking about is when the currency itself, kind of like a commodity, just becomes less valuable relative to everything else.
Precisely. And if we trace the word back, it comes from the Latin inflare, which means to blow into or to inflate. But the economic meaning, it went through this fascinating historical shift in the 19th century.
Oh, really?
Initially, in places like the United States, inflation referred strictly to currency depreciation.
So it wasn't about the price of bread going up. It was about the dollar, or I guess in the context of the American Civil War, the various private banknotes losing its value.
You've got it. It was because the supply of those notes exceeded the redeemable metal backing, like gold or silver.
Oh, I see.
During periods like the Civil War, private banks would often issue banknotes far beyond their metallic reserves. The term inflation was used to describe this swelling, this inflation, of the money supply relative to its hard backing.
So the rising prices of goods was seen as a symptom of that currency problem.
Exactly, not the problem itself. And this original view, it aligns very closely with classical economists like David Ricardo, who really stressed the importance of backing your currency with real assets.
Yeah. That relationship, that the volume of money relative to its value is the core issue, is ancient, but the language keeps evolving. Okay, so let's quickly equip our listener with the essential vocabulary they'll need to follow any macro debate.
Certainly. We know inflation is the general rise. Its precise opposite is deflation.
A sustained fall in the general price level.
Right. And that's often viewed very negatively by economists, and we'll definitely explore why later.
Then there's disinflation. This is a term we hear a lot when central banks are trying to, claim a victory.
Yes. And disinflation is crucial for distinguishing effective policy. It is not a price reversal. Prices are still rising, but the rate of that rise is slowing down.
So if inflation goes from, say, 7% down to 3%, that's disinflation.
That's disinflation. If it goes from 3% to -1%, that's deflation.
Got it. And what about the worst-case scenario, the one that defines monetary catastrophe?
That is hyperinflation, an out-of-control inflationary spiral. Our sources highlight Venezuela, which, as of October 2018, experienced an annual inflation rate of 833,997%.
That number is it's hard to even comprehend.
It is essentially a total collapse of faith in the currency. Money loses all utility as a store of value or a medium of exchange.
And then there's the dreaded combination that haunted the 1970s.
Stagflation. This is arguably the most challenging economic environment for policymakers.
Why is that?
Because it combines high inflation with two symptoms of a recession: slow economic growth and high unemployment. The traditional tools just don't work.
So the tools you'd use to fight a recession, like stimulating demand, would just make inflation worse.
And the tools you'd use to fight inflation, like raising interest rates, would just make unemployment worse. You're stuck.
We also need to distinguish between that core inflation and price changes in specific sectors, right?
Right. We have asset price inflation, where the prices of financial assets like stocks, bonds, real estate, they're all increasing rapidly.
Often because there's a lot of liquidity, a lot of cash in the system.
Exactly. But the prices of everyday consumer goods, the stuff in the CPI, they don't necessarily follow immediately. And then you have terms like agflation.
Agflation.
Which describes a disproportionate increase in the price of food and agricultural crops compared to the general rate of inflation.
Okay, so if the concept of currency devaluation is that old, let's trace its historical mechanisms. The earliest forms of inflation weren't about central banks or monetary policy. They were about, well, the physical, governmental manipulation of currency.
Indeed. The earliest documented inflation, it occurred in Alexander the Great's empire around 330 BC, driven by his massive expansion and this sheer volume of coins he minted. But the Roman Empire, that provides the classic, crystal-clear example of how the mechanism works: debasement.
Okay, tell us how the Roman government effectively manufactured inflation and funded its operations through the coin itself.
It was a simple, profitable, and ultimately disastrous cycle. When the Roman government needed more money to fund its army or its bureaucracy, it would recall silver coins.
The ones already in circulation.
Yes, they'd melt them down and then mix the silver with cheaper metals like copper or lead. Then they would reissue a greater number of coins at the same face value.
So the government was secretly reducing the real metallic content of the currency while telling everyone it was worth the same. The citizens still had a coin called a denarius, but the intrinsic value of that coin had just plummeted.
Exactly. When Nero was emperor around AD 54, the denarius was more than 90% silver. By the 270s, during all the military crises and internal chaos, the coin contained hardly any silver at all.
Wow.
By that point, citizens needed exponentially more of these worthless coins to purchase the same amount of grain or oil.
And the profit the government made from this process is called seigniorage, right? Could you clarify that term for our listener?
Seigniorage is the difference between the face value of the currency and the cost to produce it. When a coin was 90% silver, the seigniorage profit was pretty small.
Right.
But when they diluted that silver content down to 5%, the cost of production dropped dramatically, and the government's profit, the seigniorage, exploded. This was effectively a hidden tax.
A non-interest-bearing loan extracted from the populace just by manipulating the money supply itself.
It's a pure, state-driven increase in the money supply that led directly to a rapid loss of purchasing power millennia before we had modern fiat currencies.
And we see the inverse effect with commodity money supply changes, too. You have to consider the gold shock of 1324.
Ah, Mansa Musa.
Exactly. When the Malian king embarked on his famous Hajj to Mecca, he traveled with this vast retinue and quite literally gave away and spent enormous quantities of gold. So much gold in Cairo that its price was significantly depressed for over a decade.
That's a perfect real-world example of a sudden, rapid increase in the supply of a commodity money leading to immediate inflation, or, in this case, a dramatic reduction in the purchasing power of gold itself.
The historian who observed it noted the value of the gold mythquel fell significantly, and it just stayed cheap afterward.
And this leads us to the most significant inflationary cycle of early modern Europe: the price revolution between the 15th and 17th centuries. Over a period of 150 years, prices in Western Europe rose sixfold.
Sixfold. What were the key drivers of such a massive, sustained inflation?
Well, the sources cite two dominant and compounding factors. The first, and the most famous, was the massive influx of silver and gold from the New World into Habsburg Spain.
And from Spain, it spread into the rest of Europe.
Yes, it literally flooded a previously cash-starved continent with precious metal, expanding the monetary base significantly.
So a pretty straightforward quantity theory of money explanation seems to hold true there. More money chasing the same amount of goods.
It does, but the second factor complicates the picture. The European population was rebounding robustly after the devastation of the Black Death.
Ah, so more people.
A rebounding population means dramatically increased aggregate demand, particularly for essential goods like food and land. This demand pull inflation combined powerfully with the monetary shock from the New World silver, making the overall price rise even worse in the 16th century.
So even in pre-industrial history, inflation was already a multi-factor problem. It was a mix of money supply shocks and real economic activity shocks.
That's right.
So if that's how the historical roots set the stage, the challenge now in our fiat currency world is how we accurately measure this ever-changing force.
Moving into the modern era, the first requirement of any central bank is accurate measurement. Inflation is defined by the annualized percentage change in a general price index, and the most common one is a consumer price index, or CPI.
The CPI is designed to approximate the price changes for an average urban consumer. Let's make that calculation tangible using the U.S. CPI numbers from 2007-2008 that our research provided.
Okay, so if the index starts at 202.416 the beginning of the year, and it rises to 211.080 by the end of the year, the calculation involves finding the percentage change.
You take the difference, which is 8.664, and divide it by the starting number, 202.416, then multiply by 100.
And that gives us 4.28%. The takeaway for you is that this 4.28% is the official measure of how much the purchasing power of the dollar declined for a typical consumer in that 12-month period, based on their hypothetical basket of goods.
But central bankers need more than just the historical CPI, don't they? They use a whole suite of tools, leading and lagging indicators.
That's right. The CPI is a lagging indicator. It tells you what happened to the consumer in the past month or year.
It tells you what already happened.
Exactly, which is why the producer price indices, PPIs, are so closely watched. They're considered a leading indicator for inflation.
Why leading?
The PPI measures the change in prices received by domestic producers for their output. So think of it as measuring the cost of raw materials, intermediate inputs, wholesale components, if the costs of those inputs surge.
That's a supply shock.
It's the definition of a supply shock, creating immense cost pressure on manufacturers.
And eventually, those manufacturers have to pass those costs along to the consumer to maintain their margins.
Precisely. There is a time lag. So a surge in the PPI suggests that consumer prices, the CPI, are likely to follow suit in the coming months. It gives the central bank an early warning.
Then we have the metric that really dominates the internal discussions at central banks: core inflation. Why is the Federal Reserve, for instance, willing to exclude crucial everyday expenses like food and energy?
This goes back to their goal of long-term stability. Food and energy prices are notoriously volatile. They're affected by specific, often temporary shocks: a hurricane in the Gulf, a cartel decision on oil supply, a crop failure.
So they move sharply, but they don't necessarily reflect the underlying generalized monetary pressure in the economy.
Exactly. So by stripping out that noise, the Fed believes it gets a clearer picture of the persistent long-term future inflation trend. The trend driven by things like expectations and overall aggregate demand.
So core inflation is seen as a better predictor of where inflation will settle over the next year or two.
That's the goal, making it the preferred target for policy adjustments like interest rate hikes.
Now, here is where we get into the real intellectual friction. Despite all these sophisticated tools, virtually all economists agree on one thing: measuring true inflation is exceptionally difficult.
It really is.
And research consistently suggests that the official rate, while it's the best we have, often contains significant biases.
The problem lies in the design of that basket of goods. It contains weighted prices reflecting typical consumer purchases. But this fixed basket introduces two major sources of bias that can distort the official rate.
And the first one is the substitution effect. Explain why that might make the official rate overstated.
Okay, so when statisticians calculate the index, they track the price of a fixed quantity of items. If the price of gasoline spikes, the average consumer doesn't just keep buying the same amount of gas.
Of course not. They drive less, they take the train, they substitute.
Yeah. They substitute the expensive good for a cheaper alternative. But the index assumes they continue buying that now expensive gas at the same weight.
So their actual cost of living rises, but not as quickly as the fixed basket index suggests it does.
Exactly. The official CPI overstates the true impact of those price rises on a consumer who rationally changes their purchasing habits.
The second major issue is the challenge of quality. or unobserved quality improvements.
This is a tricky one. If a laptop costs 5% more this year, but it has twice the memory, a better screen, and a faster processor, has the real price of that functionality gone up or down?
That's a great question.
Statisticians struggle mightily to fully account for these quality improvements in existing products and the introduction of entirely new valuable goods.
And the sources suggest this leads to an overestimation of the price rise, because the index just registers the higher nominal cost without fully adjusting for the massive increase in utility the consumer is getting.
And that's before you even consider brand new products. Think of a life-saving medicine or some revolutionary software. If it wasn't available last year at any price, its introduction is like an infinite improvement in quality at a finite price. It's almost impossible to fully quantify in an index.
So we have measurement issues and we have perception issues.
Yeah.
There's a clear divide between the official rate and what people feel in their wallets, the perceived inflation gap. Why do people generally feel that inflation is higher than the government reports?
There are a couple of major psychological factors at play. First is frequency bias. People focus overwhelmingly on the prices of things they buy all the time, like food and fuel.
The volatile
The
stuff.
most volatile stuff. They buy a refrigerator maybe once a decade and forget the price, but they remember the price of eggs from last week.
And second, it's the compound effect. We often think of 2% inflation as modest, but we forget what happens over time.
A low, steady 2% inflation rate for, say, 35 years. A typical career span results in prices nearly doubling. People deeply feel that cumulative inflation, the compound pain of the erosion of purchasing power over decades, even if the annual rate itself has been stable.
To wrap up our discussion on measurement, it's worth noting the more whimsical indices that show how tailored price tracking can be. They really demonstrate the complexity of translating these abstract economic concepts into lived reality.
Right, like the globally recognized Big Mac index. It's used to compare the relative purchasing power of currencies by tracking the price of an identical standardized product, the Big Mac, across dozens of countries.
Or the hyperlocal ones like the Jollof Index in West Africa or the Two Dishes One Soup Index in Hong Kong. These measure the true cost of living and eating for specific populations, which can feel much more relevant than a centralized CPI.
And, of course, the famous lipstick index, which was popularized after the 9/11 downturn.
The idea that when people can't afford big luxuries, they turn to small, affordable ones like lipstick.
Exactly. It's an indicator of consumer sentiment and substitution behavior during tough times.
So if that's how we track the value of the currency, the next monumental question for economists is figuring out what actually moves that needle. This is where the real battle of ideas begins.
Historically, the debate over the cause of inflation has been dominated by one central question. Is inflation primarily a monetary phenomenon driven by the supply of money, or is it a real phenomenon driven by the supply and demand for goods and services?
And the oldest and perhaps most elegant answer comes from the quantity theory of money, QTM. This theory, revived and championed by the Monetarist school, led by Milton Friedman, gave us that famous assertion. Inflation is always and everywhere a monetary phenomenon.
QTM is rooted in the equation of exchange. MV equals PQ. M is the nominal quantity of money circulating in the economy. V is the velocity of money, how often money changes hands.
Okay.
P is the general price level, what we measure with CPI. And Q is the real economic output, or GDP.
So if the total amount spent, MV, must equal the total value of goods sold, PQ, what are the assumptions that make QTM so powerful in saying that money supply growth causes inflation?
Well, monetarists assume that in the long run, both V, velocity, and Q, output, are stable or determined independently of the money supply. Velocity tends to be relatively stable, and real output, Q, is determined by the economy's productive capacity, technology, labor, capital.
So if you increase M, the money supply, substantially faster than the economy can grow Q, its output, then P, prices, must increase proportionally to balance the equation. It's money chasing too few goods.
The rival approach, historically, was the real bills doctrine, RBD, also known as the backing theory. Adam Smith and many 19th century thinkers laid out this idea. It argues that inflation only results if the money issued is not backed by sufficient real assets or real bills of value.
So if a bank issues a loan, creating money against a tangible asset that is short-term and valuable, that new money is legitimate and won't cause inflation, even if the quantity of money goes up.
Correct. The RBD supporters believed that money should be issued based on the legitimate needs of trade. If money creation is backed by real value, it holds its value regardless of the sheer quantity.
whereas the QTM supporters were all about the quantity.
They said the sheer quantity mattered most, not the quality of the backing. This conflict was the first great monetary debate.
This debate then shifted dramatically with the rise of Keynesian economics in the mid-20th century.
Right. John Maynard Keynes' crucial insight was that in the short run, that QTM assumption that prices, P, will adjust quickly, is false. He emphasized sticky wages and prices.
So when demand falls, firms don't immediately cut wages or prices.
No, they first cut production and employment. Therefore, demand shocks affect output, Q first, not prices, P.
This led to the empirical observation in 1958 of the Phillips curve, which showed an inverse relationship between inflation and unemployment.
And early Keynesians interpreted this as a stable, exploitable trade-off. They believed policymakers could literally choose a point on the curve. A little more inflation for a lot less unemployment, or vice versa. This informed policy all through the 1960s.
But the stable Phillips curve was demolished by the Monetarist challenge in the late 1960s, led by Friedman and Edmund Phelps.
They argued that trade-off was only temporary because it ignored the crucial role of human expectation.
Expectations.
If the government consistently stimulates demand to keep unemployment low, the resulting higher inflation eventually becomes built in. Firms and workers aren't fooled forever, they start to expect it.
So workers demand higher nominal wages to maintain their purchasing power.
And firms raise prices to cover those labor costs, leading to a self-fulfilling wage price spiral.
The consequence of this realization was the introduction of two transformative concepts in modern macroeconomics, NARU and rational expectations theory.
NRU stands for the non-accelerating inflation rate of unemployment. It is the lowest level of unemployment the economy can sustain without causing inflation to continually accelerate.
So if you try to push unemployment below NRU,
You'll just get perpetually higher inflation as people constantly raise their expectations. This is what explained the stagflation of the 1970s, high inflation and high unemployment at the same time.
and rational expectations theory reinforced the importance of central bank behavior. It posits that economic agents look rationally into the future and use all available information to predict what policy will do.
This is why central bank credibility is absolutely key. If a central bank has a reputation for being soft, for being willing to tolerate inflation to boost short-term employment,
People will just expect high inflation.
and they'll build that expectation into contracts, making the bank's job harder. Conversely, a tough reputation allows the bank to manage expectations quickly and lower inflation with much less economic pain.
The 1970s show that neither pure Keynesianism nor pure monetarism provided a complete answer. The solution adopted by the mainstream came to be known as the modern synthesis, epitomized by Robert J. Gordon's triangle model.
This model asserts that inflation is almost always caused by a dynamic mix of three interwoven factors. First, demand shocks, or demand pull inflation. This is where aggregate demand exceeds the economy's capacity.
Classic too much money chasing too few goods, often caused by expansionary monetary or fiscal policy.
Second, supply shocks, or cost-push inflation. This is where aggregate supply suddenly drops, or the cost of key inputs skyrockets.
Like the OPEC oil crisis in the 70s, or more recently, global shipping bottlenecks.
And the third factor, connecting back to that Monetarist insight,
Expectations.
inflation expectations. Even if there are no immediate shocks to demand or supply, if consumers and firms believe inflation will be high, they act on that belief. Workers demand higher wages, firms raise prices, and that expectation feeds the wage price spiral, embedding inflation into the economy.
The modern consensus also cites several structural, real economy factors complicating the picture in the 21st century. Things like chronic housing shortages, shifts in immigration affecting labor supply,
And climate change. Climate change is increasingly cited as a driver because recurring extreme weather events translate directly into supply shocks for agriculture and commodities.
causing unpredictable spikes in food and input prices that then feed into the broader CPI.
The 2021-2022 inflation spike provides a perfect case study for this triangle model synthesis. We saw all three elements operating at the same time after the COVID-19 pandemic.
It really was textbook. We had massive demand shocks from unprecedented fiscal support stimulus checks, government aid,
Combined with highly accommodative monetary policy, low interest rates, quantitative easing, and at the same time we had severe supply shocks.
lockdowns, logistics bottlenecks, and later the energy crisis from the Russian invasion of Ukraine.
But during this period, a new critical argument gained traction, the idea of seller's inflation. What is this theory asserting?
This argument suggests that the demand and supply shocks provided cover for highly consolidated firms to significantly increase their profit margins, to price gouge, contributing disproportionately to the inflation spike.
So they were exploiting the price inelasticity that resulted from the supply chain constraints.
Right. The argument goes that when a market has fewer players, those major corporations can raise prices, and consumers, who lack alternatives, just have to pay the higher price. They choose to take increased profits rather than absorbing the cost increases.
That's the core claim. However, this is where that intellectual friction is essential. Critics of the seller's inflation theory argue that high corporate profits are often just a symptom of supply constraints, not the primary cause.
So how do they distinguish between those two explanations?
They look at the source of the price change. If prices are rising primarily because input costs are rising, that's classic cost push. If prices are rising and firms' profit margins are also increasing at an unusual rate, that strengthens the seller's inflation argument. It remains a very ongoing, highly political debate.
It shows that even with modern tools, diagnosing the specific cause of an inflationary surge is incredibly complex.
Finally, let's address the monetarist resurgence after the pandemic. M2 money supply growth surged post-COVID, and many linked it directly to the inflation that followed. Yet we noted former Fed chairs downplayed that link. Why?
This is a sophisticated point about the current state of monetary transmission. Former Fed leaders have acknowledged that the once strong direct link between the money supply, M2, and consumer price inflation effectively ended about 40 years ago.
Because of financial deregulation and innovation.
So why has the equation changed so much?
The key concept here is the velocity of money, V. If the money supply, M, increases, but that money isn't quickly spent and circulated through the consumer economy, if velocity is low, its inflationary impact on consumer goods, P, is dampened.
And where did all that money go post-COVID if it wasn't immediately fueling consumer prices?
A significant portion was held in the financial system, in bank reserves, excess deposits, or concentrated in asset markets like stocks and real estate, which fueled asset price inflation. It wasn't circulating rapidly in the hands of the average consumer buying groceries. The whole system has changed.
So, understanding the cause of inflation requires us to be economic historians, psychologists, and systems analysts all at once. Now let's turn to the critical question. What happens when inflation is too high, and what happens when it's too low?
The general effect of inflation is clear reduced purchasing power, but the specific consequences are often uneven, creating winners and losers. We must first analyze the significant hidden costs and negative effects of high or unpredictable inflation.
And one of the most insidious effects is that inflation acts as a powerful redistributor of wealth and purchasing power.
That's right. Inflation shifts purchasing power from those who hold financial assets denominated in currency like cash, savings accounts, fixed nominal incomes, toward those who hold physical assets.
Like property, gold, or inflation-indexed stocks, and critically, toward debtors.
Precisely. If I took out a fixed-rate 30-year mortgage 10 years ago, and inflation is suddenly 10%, the real value of the debt I owe the bank is effectively being inflated away. I win. The lender loses.
And it hurts those on fixed nominal incomes, like many pensioners whose benefits aren't perfectly indexed to inflation as their monthly checks buy less and less.
Beyond redistribution, high inflation gums up the smooth operation of the economy, leading to economic inefficiency.
How so?
Unpredictable inflation makes long-term investment planning extremely difficult for businesses. They have to divert resources and attention away from core activities, like boosting productivity, and instead spend time focusing on managing constant currency profit and loss fluctuations. It's a severe drag on growth.
And it creates confusion in the marketplace that leads to a loss of allocative efficiency. Can you use a conversational example to explain that complex idea?
Absolutely. When prices are stable, a change in a specific product's price sends a clear signal. For instance, if the price of lumber suddenly jumps 20% while everything else stays the same, that's a signal to consumers to conserve lumber and to producers to invest in more logging capacity.
That's efficient.
But if general inflation is raging at 15% and lumber rises 20%, it's hard to tell if lumber is genuinely scarce, or if its price is just rising slightly faster than the general background noise. That confusion leads to misallocating capital and resources.
We mentioned earlier that inflation is often called a hidden tax.
It acts as a hidden tax on holding currency, just eroding its value passively.
Hmm.
Furthermore, if tax brackets aren't indexed to inflation, a phenomenon known as bracket creep, inflation can push you into higher marginal income tax rates, even if your real purchasing power hasn't increased.
A subtle, non-legislated tax increase.
Exactly. The sources also cited a profound, severe consequence, the direct link between food inflation and social and political fallout.
It's a critical. High food inflation directly impacts the most vulnerable populations globally.
For instance, high food costs were cited as a major underlying cause of the widespread demonstrations and revolts that fueled the 2010-2011 Tunisian and Egyptian revolutions. When people cannot afford basic sustenance, economic metrics become immediate drivers of political instability.
We also need to define the two classic microeconomic costs that illustrate these subtle inefficiencies. First, the shoe leather cost.
High inflation dramatically increases the opportunity cost of holding cash. The term theoretically references the energy and time, the shoe leather, spent by people running back and forth to the bank to minimize their cash holdings and keep their money in interest-bearing accounts.
It's wasted time and effort managing cash instead of doing productive activity.
And the second is the menu cost.
This is the explicit or implicit cost for firms that have to constantly change their prices. A restaurant having to reprint its physical menus every month is an explicit cost.
And the implicit cost includes time spent updating computer systems, changing price tags, negotiating with suppliers. Both costs consume resources that could otherwise be used to increase output.
Okay, now we flip the coin. Why do central banks consistently target a low but positive inflation rate, typically 2% in the developed world? Because inflation has some powerful upsides.
The primary positive effect is related to greasing the labor market. This addresses a fundamental truth about human behavior. Nominal wages are sticky downward.
People hate pay cuts.
Workers strongly resist pay cuts, even if inflation is zero and a pay cut is economically rational.
So if the economy needs wages to drop to clear the market, say during a recession, but workers refuse nominal pay cuts, the result is prolonged disequilibrium and higher unemployment.
Precisely. Moderate inflation provides a mechanism to allow real wages, the actual purchasing power of the paycheck, to fall slowly, even if the nominal dollar amount of the wage stays the same.
It acts as a necessary lubricant for economic adjustment.
Inflation also grants the central bank essential policy flexibility, or room to maneuver. This prevents the central bank from hitting the feared liquidity trap.
Right, where you can't cut interest rates any further because they're already at zero.
Exactly. If moderate inflation is built into the system, say 2%, then a zero nominal rate still equates to a negative 2% real interest rate, providing stimulus and ensuring the central bank retains its policy tools.
We also have the academic argument for why moderate inflation might actually spur investment, known as the Mundell-Tobin effect.
The Nobel laureate Robert Mundell argued that when inflation is expected, it raises the opportunity cost of holding non-interest-bearing money. Why hoard cash that is constantly losing value?
It encourages you to invest it instead.
It encourages savers to substitute money hoarding for capital formation. They invest in loans, stocks, productive capital. This substitution leads to a fall in real interest rates and increased investment, thereby stimulating long-term growth.
And finally, the ultimate justification for avoiding zero inflation: the inherent instability that comes with deflation.
This ties back to economist S.C. Chang's compelling argument. Expected deflation is dangerous because it encourages money hoarding, as money is constantly increasing in value. This hoarding euthanizes financial markets.
And Sang warned that if this massive pile of hoarded money is suddenly triggered into circulation by some panic or change in expectation,
the resulting mass movement to spend would become a tremendous avalanche, causing rapid inflation and severe disruption as the financial system just cannot cope.
So stability is the key. Moderate, stable inflation prevents that fear of deflation and provides the necessary mechanism for markets to operate smoothly and for central banks to manage employment and demand.
The modern objective of central banks is not just to manage interest rates, but to manage inflation expectations to keep the rate low and stable, typically around 2%. And to achieve this, economies have historically relied on various nominal anchors.
The classic anchor, dominant globally before World War I, was the gold standard.
Under the gold standard, a country tied its currency to a fixed, preset quantity of gold. The long-term inflation rate for the economy was effectively determined by the rate of growth of the global gold supply.
What were the major criticisms that led to its abandonment?
Critics argue it forced arbitrary fluctuations in the inflation rate, totally dependent on gold discoveries, not on the needs of the domestic economy. And more critically, it made it incredibly difficult to stabilize employment and avoid deep recessions because the government couldn't independently adjust the money supply,
It forced rigidity.
a rigidity that was ultimately abandoned after the Great Depression.
After World War II, many nations adopted a different anchor, fixed exchange rates under the Bretton Woods system.
This system involves pegging a currency to a major low-inflation currency, historically the US dollar. Today, only a handful of nations like Denmark maintain a fixed rate against an anchor like the euro.
The benefit is you import the anchor country's price stability.
But the cost is the loss of policy independence, right? You can't use your own independent domestic monetary policy setting your own interest rates to manage local business cycles or unemployment. You sacrifice domestic control for external stability.
A more drastic and much less popular control mechanism is wage and price controls.
These are temporary, exceptional measures. They can theoretically be effective at speeding up disinflation and breaking those entrenched expectations quickly. But economists generally advise caution.
Because they create severe market distortions, shortages, black markets, misallocation of resources.
As seen in the failure of the 1972 U.S. attempt to impose controls, they only work if the controls allow the central bank time to tackle the underlying causes, like excessive demand.
Let's look at another alternative idea that focuses on structural monetary reform, the demurrage currency from Freiwirtschaft theory.
This is a fascinating theoretical construct. It proposes a currency designed to inherently decrease in value over time, a demurrage cost, like a storage fee.
So it discourages hoarding.
Right. And since it discourages hoarding, the central bank could theoretically issue new money at a similar rate to the demurrage cost to achieve a precise zero inflation target. The theory posits this also replaces the need for interest costs to be built into prices.
But the undisputed global standard today, the framework used by most developed economies, is inflation targeting.
This approach was pioneered by New Zealand in 1990 and is now prevalent across the G7. It involves the central bank explicitly committing to continually adjust its primary tool, the central bank lending rate, to steer the country's actual inflation rate toward a specific published target, typically 2%.
And the mechanism by which those interest rate changes affect the economy is called the monetary transmission mechanism. How does that link work in practice?
When a central bank raises its target interest rate, it raises the cost of borrowing for commercial banks. This increased cost is then passed on to consumers and businesses through higher loan rates, like mortgages and corporate bonds.
That makes borrowing money more expensive, which slows spending.
Exactly. Higher borrowing costs decrease aggregate demand. Both consumers and businesses spend less. Lower demand reduces the pressure on existing supply, which puts downward pressure on prices, thus influencing the inflation rate back toward that 2% target.
And lowering rates does the opposite, stimulating demand. It's all designed to anchor those crucial inflation expectations.
It truly is incredible if you step back to trace this journey from Nero's crude debasement of the denarius for quick government profit through the intellectual battles over the quantity theory and the Phillips curve.
Right up to the highly sophisticated debate over the NARU and the credibility of a single announcement from a central banker.
Inflation isn't just an economic metric. It's a reflection of the trust in the underlying value of a society's promise of exchange and the competence of the institutions managing that promise.
So what does this all mean for you, the informed learner? We've established that unstable inflation causes enormous social and economic harm, from redistributing wealth and discouraging investment all the way to fueling revolutions.
We also noted that the instability that comes with deflation can cause savers to hoard, and that a sudden, panic-driven movement to spend those hoards could become a tremendous avalanche.
That concept of the Shang avalanche, a sudden mass realization that money hoarding is no longer safe, leading to panic spending, is a powerful warning.
It really is.
So given the immediate, highly emotional effects of inflation on consumers, which we saw vividly in the social unrest of 2010 and 2011, and the fact that we now live in a world of instant digital communication, flash trading, and globalized assets. What happens when this avalanche of money hoarding and the subsequent rush to trade money for real goods is amplified and accelerated by social media narratives and the speed of modern financial flows?
This raises the ultimate question for contemporary central banks. Is inflation today as much a psychological and communications challenge, a battle to manage public narratives and expectations digitally and instantly, as it is a purely monetary one, controlled by the relatively slow mechanisms of interest rate adjustments?
The battle for stable prices may well be won or lost in the realm of public perception.